Welcome to the Dividend Talk podcast, episode 118. Our thoughts about dividend irrelevance theory. Hey guys, welcome back to another episode of Dividend Talk. Today, myself and European DGI will discuss our thoughts around the dividend irrelevance theory. All that and more. See you on the inside. Yo, European DGI. How are you this weekend, man?
Really good. Of course, I'm always looking forward for this podcast, right? And it's never a dull moment, even if we're really busy at work. I mean, look at what's happening again this week. And I don't know if you noticed, even today, McDonald's hiking 10% their dividends. So to all the McDonald's shareholders, congratulations. I sold it at 120 after buying at 95 at a 4% yield because I was thinking it was overvalued. That was then. Now is today. I'm bloody jealous. I should have followed them. But congratulations to everyone. Enjoy those juicy dividends. It should at least give some people an extra burger per month.
Exactly. I can afford something off the euro or the pound saver meal, but it's they have a really decent dividend history. I'm surprised you actually sold them. You're not one to sell because they're overvalued. Let your winners win. Isn't that what you say? So.
Yeah, but I sold this like 5-6 years ago, and then I wasn't that, I guess, wise yet. Who knows what I will have learned in 5-6 years from now, of course. But at that time, I thought I was smart in this, but also just you get influenced by all these books from Warren Buffett about value investing, and he doesn't invest for dividends. He sells his holdings as well when they are overvalued. So I was often thinking then, when are my holdings overvalued? I also thought like, oh, if I sell this now, I can buy maybe a 5% yielder back for this. So also this opportunity thinking in there, right? And I think many of us go through this phase when we are developing our own investment philosophy, because we take inspiration from, I don't know, influences about dividend investing. We take from books, YouTube. There are many friends, family, right?
Yeah.
And all these inputs, they start to shape us, and we play with these things, right?
It's a constant learning process. Look, if you listen to this podcast over, what are we doing it now, 2.5 years nearly, you can probably see how we've changed, how our thinking's changed, what we've been buying, what we've been selling, how our thoughts have changed. It's constant changing. You read things, you learn new things. I mean, I think I'm the same. Everybody's like that. You sell something, you buy something with a higher yield, and then it turns out to be Walgreens, and it's after losing you a ton of money. But I mean, you learn from mistakes. That's part of the process. But I mean, a company like McDonald's, they are flying burgers. Are not going out of fashion, even though there's a recession looming. And look, they're more of a real estate company anyway, aren't they? They've got their pies, got their fingers in a lot of pies. But I mean, I'm happy for all you McDonald's holders out there. I'm not, and I am jealous of it. Inflation beating dividend increase. That's what I would call it.
Exactly. And I like how you're talking about changing, that we're constantly changing, and that you don't use the term progress.
Yeah, well, sometimes it's progress, sometimes it's not progress.
Exactly.
It's all part of the learning. I mean, we still make a lot of mistakes. So, but I think the long-term trajectory is up. So there is progress over time. But
yes,
I mean, I'd say we follow the market cycle. We're a bit choppy. So we're a bit choppy.
Yeah, exactly. And the only constant thing is that I'm throwing money at the market every month. And that I'm trying to stick to my plan, right? That's the main one, and yeah,
that's all we can do. But speaking of choppy, my good old neighbours over in the United Kingdom, I mean, they're turning into a bit of a laughingstock over there. It's really, I don't know. It's really embarrassing watching what's going on. I know they sacked their finance minister now after. I mean, look, they came out with a budget. it made no sense really. And I think a lot of people in the UK, a lot of my friends were the same. They were thinking it makes absolutely no sense. So there was a backlash over this. And now Liz Truss has to have an egg on her face and sack her finance minister. I mean, it's really embarrassing. And a funny story, and I know you know about this, but the Daily Star, which is a British tabloid, have a live video stream of Liz Truss and a lettuce to see which one lasts the longest.
This is pure British humor.
It is. It's absolutely brilliant. But if that doesn't tell you the state of politics or the state of what's going on over there, it's mind blowing. I mean, they had such an opportunity leaving Brexit to pave their own way and to do their own thing. But I mean, it's making their decision. I didn't think leaving Brexit was going to be such a bad thing for them, but man, they're making it a lot harder than what it should be.
But what can I say? If we are a bit fact-based, right? So we read beyond the headline. And I read today that they want to increase the corporate profit tax from 90% to 25%. Yeah, that's quite a lot. So that means for our companies, British companies in our portfolios, the payout ratios might potentially go higher because of the tax impact impacting profits, right? Net profit. Yeah. So that's what I'm reading here, and what doesn't make me too happy from that point of view. Although usually my companies have a little bit of margin in the payout ratio, but these are not good developments, right? And before you know, they start introducing a dividend tax or something like that.
Yeah, but then I'm going to look at this from Irish eyes. I mean, companies that want to stay based in this western part of the world, they look at the tax. Their corporate tax is going to increase in London. They'll come over to Dublin. I mean, it's 15% tax, so we might benefit there as well. So, but I understand it's not good. It's not a good thing when they start looking at companies, because companies will obviously look at it and say, I'm paying X amount more here. Why would I stay here? I mean, most companies have offices in many parts of Europe. It's not a big deal for them to move head offices. So,
but this was the finance minister that he was kind of proposing, right? Tax the rich less and the companies less, so that the money trickles down into the economy to people. And this is also more American thinking, I think. But in Europe, you need to read the room. Yeah, the people are hit by inflation, and then making it cheaper for the rich. Even if he would have been factually right, you can't sell that in these times.
In theory, it sounds like it could work in theory. But then, as you said, you have inflation, you have people starting to lose jobs, you have talks of recession, you have companies making record profits, you have all these things happening at the same time. And people are just saying, oh, wait a minute. Why are you giving them a tax break? We need the tax break. So you can understand the logic behind what he was trying to do, but I mean, it was just completely the wrong time and the wrong moment.
Yeah, you don't read the room when you get such an.
He's just gone in with blinkers on. He just went in head first, and he just got turned around and kicked straight out the door. But I mean, they're in serious trouble over on that side. Well, my side of the world, they're in serious trouble over here at the minute.
Yeah, and the ice is melting in the north, so who knows?
I'll be living up the top of a mountain. I'll be okay.
Good. Hopefully, I will see it soon, because I have this buy me a coffee, and I'm now at 70%. So who knows? Maybe we'll see each other still before the end of the year. So again, people, if you want to support us to meet each other face to face, I'll put a link into the description. buymeacoffee.com/EDGI. That's, I think, the link. And you can buy us a coffee. And from that, you're sponsoring me to visit Ireland and to have a live podcast. So I'm really looking forward to that.
We need to get you here in December, because nothing happens in October, nothing happens in November, but in December we have this little festival, and it's actually really nice. So we need to get you here. We have 6 weeks. Let's get you here.
Yeah, we're really close. Good.
Anyway, Philips. I know they're on. I don't know. You sold them. You bought them. You sold them. They're on your list, and they are. I mean, if you like them at 27, 28, you're going to love them at what are they trading? €14 now.
13.5, yeah. No, I'm staying away from it now. Remember, they promoted an intern to CEO, probably really talented, but probably also no experience. It's a shitty time to take over, right? And I know the current CEO is still also a bit in around there, let's say. But yeah, they are expecting a comparable sales decline of approximately 5%. And honestly, we see everywhere profit warnings, right? So in itself, it's not so surprising that Philips also has a profit warning. I wouldn't be surprised if a company like Medtronic or other companies like that in this space will face something similar. But it's not just that. Then they also mention again, order intake is declining, okay, but then a goodwill impairment charge of 1.3 billion for their their respiratory care business. And we know, of course, what happened there with COVID, right? And the foam in there. Yeah. So the story just doesn't end, right? Then it's a reservation they make for litigation. Now it's a goodwill charge. And what it all is telling us, like, the balance sheet is just deteriorating. So I have no clue whether the dividend is safe, right? If you look at the earnings, they should be able to pay for the dividend. But, we have seen Bayer, like a few years ago, that had this trouble. And for me, it is really now a value trap. It continues just to go down and down and down and down. This Philips profit warning, they dropped 10% or something like that. I'm glad I stepped out. I'm really glad I stepped out.
The dividend looks safe, to be fair. From a free cash flow point of view, it sits around 50, just under 50%. So from that point of view, the dividend looks safe. You get them at a whopping 6% dividend yield, but the story behind the company is just too irregular for me. We have litigation, we have goodwill charge, we've everything that I've said this year that I want to stay away from.
Yeah,
3M and Philips are those companies right now.
Yeah, and then 1.3 billion goodwill. The market cap is 11.9 billion. Yeah. I know you can't look at it like that one-on-one between balance sheet and market cap, but it shows you how much money this is, right? But yeah, hey.
Well, they're what's the dividends? The dividends paid
6.3% now. 6.3%.
Yeah, I think they repurchased stock this year of 1.3 billion as well. So like that goodwill charge is another year's worth of buying back stock. So I don't think the dividend is in trouble. If they cut it, I don't think it'll be severe. It might be something like what Danone did or whatever. But
yeah, exactly.
For me, it's just the story behind the company. It's the litigation, it's the management, it's everything that's going on. But there's a time where that might change. They are a value trap, but do you really think Philips are a company that will go out of business? No. So at some point, it might be a turnaround company.
But how many turnarounds do we have?
Yes, that's
Intel
is
a turnaround. Bayer is a turnaround. Danone is a turnaround.
That's the problem, and that's why they're so cheap. But then on the other hand, you have to fight with yourself, saying, you hear what's that saying, boy, when there's blood on the streets. That's another one they say, and there's blood splattering all over the place here. So
the only thing that I could do with a company like Philips is, like, if the general market starts to bottom and we're starting to see a little bit of an uptick and more good news in general, that you buy like a long call, like 2 years out. That you pay a little bit for it, but then you see how it goes. At least then, because I did this with Shell at 11 euro or something like that. I bought a long call at 16 euro at the time, and it became 20. So I made a nice profit on that. So that's something I could do with Philips, but other than that, no. I follow it. It's an iconic company. It hurts me to see it. Yeah, I grew up in the Netherlands, so there's some attachment to the brand. But this, Anyway, talking about staying a bit close to Philips's area, the chip industry, ASML dropped 10% almost. because TSMC, Taiwan Semiconductor Manufacturing, is cutting its capex by 10%. And when they talk about capex, such companies, they talk also about the machines they are buying from ASML, right? But also from Liam Research and those companies. So they were really slaughtered this week on this news. And at the same time as Biden, our friend, the American president, is introducing even more export rules, towards China, which also impacts European companies when they are using American, let's say, equipment or something like that in devices, at least from what I understood. So yeah, it's becoming tough now. ASML under 400 euro. I put a buy order at 375. It went this week to 376, and before I blinked my eyes, it was back above 400. We had like a flash crash this week. I think it was on Thursday, but I put a buy order at 375. Full disclosure to all the readers. It will not be a large one, really small one, because I'm really slowly accumulating in the stock. The yield is too low to throw a lot of money at it. But there's such a stock that maybe I will not benefit from the dividends, but at least my kids at a certain moment.
Yeah, I mean, their share price was down 9%, but that's half the problem when you rely on a small subset of companies for your business. You're always, there's the news around them will affect your share price. If the yield was a lot higher, that would not be such a problem. But for a company like ASML, you're probably wanting a little bit more in capital appreciation than dividends, because the dividends is was just 1 point.
Yeah, but they trade now at 26 PE, right? And if you look at the growth and the order book and everything, for me, I know that the market sentiment is totally different now, and there's some risk priced in. But for me, this is really, really a nice price, and this not due to anchoring. When I did my modeling, it was more towards the 600 euro. Maybe I was a bit optimistic there, but 375, I'll take some.
Yeah, and you also mentioned Biden's export rules. I'm not, look, I don't know the details. I haven't read a whole load about it, but I can't work out if that will benefit Intel or not. I mean, why are they doing it? They're obviously doing this to hurt China and maybe to protect their own and stuff, but I can see it having the reverse effect. I really can.
So I think what Pat Gelsinger did really brilliantly is to get Biden behind the CHIPS Act and everything. He did this really brilliantly, and I think this is a big tailwind for Intel. And I know people are often bashing Intel, but I think they secured kind of a certain amount of production at a reasonable price that they will be taking the profits from, so that they can also, when those fabs come online, can invest also in their further competitive advantage. But I think they did it brilliantly. I also think that Intel did really well to share the costs with, was it BAM? I think one of those companies. Yeah. I think Pat Gelsinger is there making really smart moves, but I hope that he keeps equally as much focus on the engineering part of it. And yeah, let's see.
Cool. That was a lot of news, and hey, look, there was a lot more we could have spoke about, but we do have a show outside of the news to talk about. And today, as dividend growth investors, we're going to give our thoughts on the dividend irrelevance theory. And just a brief overview, that's some financial theory out there that claims or states that dividends does not increase a company's potential profitability or its stock price. What are your initial thoughts about it? What's your understanding here?
So, I get this question from time to time on social media, that someone jumps on and said like, "Oh, dividends are irrelevant." And actually, this week I also read a paper about it, and it's also the idea that if a company issues a dividend, declares a dividend, that the stock price goes with the same amount down. Yeah, so why bother, right? But there's more to it, that you also can better reinvest into growth, like what Google is doing, right? They don't want to pay a dividend because they want to reinvest in growth. And all these things are correct in its theory, but the underlying assumption is that there is a full market efficiency, an efficient market, which I don't believe in. And I've seen enough evidence now in the last few years that I said, and that in my opinion, stocks do get mispriced here. And because there is no full information transparency. There are, for instance, on Wall Street, people are closer to the information than for instance, us. Some information is not enough transparent, only a few people, right? So I don't believe in efficient markets like that. Maybe on a holistic way a bit, but not like that. So the theory and such is really interesting to read, because actually you're talking here also about capital allocation. Generally, you can do buybacks. They are probably more tax efficient again, right? So there are many reasons why you wouldn't want to have a part of the profits from the company. But this whole dividend irrelevance theory is, for me, again, therefore also irrelevant. Yeah, because why do you own a part of a business? Yeah, why do you own it? If you ask this question yourself fundamentally.
I mean, I think the argument out there is total return, and not just what is it, bird in the hand, as they call it, dividend investing, not just that cash return that we get. So the argument will be total return, and total return should be your focus and not dividend. I think that's one of the main arguments for this. That's why you own a company in this world.
Yes, but this applies mostly to the stock market.
Yeah.
But if you think of yourself as a business owner, yeah, what do you want to take out of the business as a shareholder is a part of the profits.
As much money as you can.
Yeah, imagine you're an investor in IKEA and the fucking family will never sell it. Yeah, or Lego. Yeah. There you are. Yeah. How are you going to ever get something back? Yeah. You want to have the profits out of the business, share of the profits. So that's the basics of capitalism, right? So, and then secondly, why it's really irrelevant for me is that I'm a passive income investor. Yeah. So when you're a dividend investor focused on growing passive income, then the whole dividend irrelevance theory is irrelevant for me, because I'm not looking at that. I mean, I can give you some other examples why I think a growing dividend is really good for a company as well, because it puts pressure on sustainable earnings growth. You need to do this in a sustainable way with a good balance sheet, not taking on debt to pay the dividend, as an example, because then your dividend policy will not satisfy us. I mean, if you talk just about high dividend companies, right, that don't have a dividend growth policy, we're talking about something else. But I'm particularly speaking about dividend growth policies. I think this is a really, really good incentive to commit yourself to that as a management team, because it means that you always feel the pressure of creating your free cash flow and earnings over time. And how can you do that? By creating a high return on invested capital. How can you do that? By innovation and really smart acquisitions. And those two, innovations and smart acquisitions, are for me two really, really big growth drivers for any company to find the next leg in the seasonality of how a company grows.
Yeah. And then you look at one of the key points there, which is around dividends can hurt the company because management could manage that money better. And there's always four main options given. One of them is reinvest in the business, acquire other businesses, pay off debt, or buy back shares. And again, you talk about efficient markets. I think this also assumes efficient management. We all know management is not created equal. How do we know management can reinvest in the business better than what they're doing at the moment? How do we know?
I think there maybe someone like Warren Buffett, but most of the CEOs definitely not. I would say such an Adela probably.
Maybe, but Warren Buffett is not partial to mistakes either. Everybody makes mistakes.
Exactly.
So
Exactly.
they're human at the end of the day. So they're prone to make mistakes. Acquiring other businesses always sounds great, always. But we can see numerous examples where it's hard to integrate into their culture or take over business, or they don't work. We got Boya with the Monsanto. We got lots of different things happening that it's not always a good thing. Paying off debt is actually one that I do kind of agree with, depending on the level of debt. I mean, if you've got a higher level of debt, yes, I agree with that. And buying back shares, yes, that's more tax efficient. But then again, you are relying there on the share price going up, and we know that doesn't always happen. Either.
And for me also, it's really hard. So if you look at one of my weaknesses is knowing when to sell. So if I even look at my own character, I would have loved to have bought all those high growth stocks in 2020 and enjoy the ride, but probably I would be sandbagging now all of them. Because I would have stayed attached to them, and I would have probably listened more to their business story and think like, the price will get back. And so I don't know when to sell often.
There's always 3 or 4 companies that are always thrown about when they speak about this, and you'll hear Google, Alphabet, Amazon, Facebook. These are not typical, and I don't think people realize that. I mean, there's maybe 5 or 6 companies in that bracket that has had that growth and sustained it to the level that they have. It's not typical. It's hard to find those companies. Getting into those companies now, how much more can they grow? I mean, I mentioned Facebook there. They've been in a decline even since before. Even when companies were growing over the last 2 years, they were declining. So, to your point, when do you sell them? When do you know you've made enough? I always struggle with that. The only way I can see this has some merit is around the debt level, and some companies having to take out loans or taking on additional debt or financing to pay a dividend. Yes, in that case, I agree with this. The dividend is irrelevant. If you have to borrow or finance or jig something around to pay a dividend, then no, you should not be paying.
And the nice thing is that we as dividend growth investors are not stupid. We look at these trends when we want to buy a company, and we look at these trends when we are observing a company that we own. And those are actually often sometimes that do lead to our sell criteria. Like, for instance, a dividend cut or something like that. We want to probably do it before a dividend cut. So I theoretically, I really get the dividend irrelevance theory, but it assumes indeed, I guess, that you would want to live off the share price or the total return approach. And you would even wonder, why ever pay a dividend as a company? So then you're never talking about total return, but always about share price appreciation. And it doesn't fit my style. It really doesn't. It's not even that. It doesn't fit my character.
And same with me, which I think we've established before. But I mean, I think there's some flaws in this theory. I mean, there's another 2 aspects of it, and one of them suggests that the payment of dividends has little to no impact on stock price. And then you read down, and then all of a sudden it says, okay, actually, we have an efficient market here. So when a dividend is paid, it's going to drop by that exact amount. So on one hand, you're telling me it has no effect on price, and now you're telling me it will have a negative effect on price. And I think we can agree that, look, when on ex-dividend date, the share price on opening bell will usually drop, but it is not always by the amount of the dividend. And I have some examples of that. ZIM which is one I did a dividend capture on. They paid a huge dividend of $17.50. I think they opened 14, so there was an extra $3.50 to be made there. Just on opening. Just one example. I mean, it can happen. It does happen, but we don't have an efficient market that just stays flat either. We have a market that goes up.
I've never really observed it with a stock like Johnson & Johnson.
No,
I think they're so predictable, so reliable. If you would say they're efficient markets, then it was already priced in that they will still pay another 4 quarters of dividend. So why sell that day?
It makes no sense. And I get it. I know people are saying, look, you're taking money out of the company and you're giving it to you. That is exactly what they're doing. That's exactly what I want. But that doesn't mean the share price stays still. And I think that's the one thing people fall down over on this, is that they assume the stock price falls, which we established can do, but it stays there. But that's not true in any market.
That's like, and that's day trader behavior.
Yeah.
I mean, I think we have bashed it enough now, the irrelevance of the dividend irrelevance theory. So I have enough content now that if someone challenges me on social media, I say, like, listen to podcast episode 118 and get back to me.
Yeah.
Because I think we're preaching for the choir here.
It has some relevance in dividend investing, but we're dividend growth investing, which is completely different.
Yeah,
and
exactly.
I think that's the key takeaway. And as you said, we look at the trends, we look at the debt levels, we look at all these things, and I just think this is it's like the Chancellor of the UK came in with something in theory that looks shiny, looks good, but in reality, the market is choppy, and dividends are better in my pocket than in the company's pocket, and that's where I want them to stay.
Good. Well, I hope we have clarified this once and for all about the irrelevance theory. And I guess it's time for a few listeners' questions.
Cool. So the first one is from Manny Mystery. In show 115, we talked about the possibility of investing in bonds. When we invest in shares in company, we always consider the risk, but often we look at investing in government bonds, we look at the yield, but we don't look too closely at the risk. Considering how Western governments have become highly leveraged and the decisions our leaders have made, what do you think about the risks involved in these?
I think honestly that bond investing, and I guess we're also, I think sometimes maybe myself may also make some mistakes between bonds and kind of treasury bonds, right? Because for me, there's still a little bit of a difference in that. When I look at treasuries, honestly, when I think about America, I really have no real doubt there, because they own the currency of the world. Yeah. And for the rest, +1 to what Many Mystery says, I think there's definitely risk involved, and we have seen it with Greece. What can happen? And I think if you look at Dutch bonds and such, I think you're relatively safe there. The culture is also on the safe side, and I think that's important to look at when you want to invest in such ones. I rather have corporate bonds in this regards than of AAA companies.
Yeah, you mentioned Greece, but I don't think they're in the same caliber. If you say the UK, some of the big hitters, maybe France.
Well, UK is on a nice path to there.
It is, but if you were to step back at the bigger picture and look at it, you would say maybe the US, UK, Germany, France. If you were to look at them, and if you buy treasuries or bonds in these countries and they fail, we've got bigger issues. That's the way I would look at it. I think they would be as safe as can be. There's always risk, but they would be, in my opinion, more safe. If they drop, you're going to have, even corporate bonds, you're going to have everything. There'll be massive issues in my opinion. Tim has asked us, what is their opinion on Medtronic versus Abbott, if you're to look closely over the long term?
Yes, so full disclosure, I own some Medtronic. I really like the company. But if I compare with Abbott today, I like Abbott, ABT ticker, a little bit more. And by the way, for the insiders, I believe AbbVie is a spin-off from Abbott at the time, right? So if you will combine them both, I mean, the dividend growth record looks really stellar from those times. If I would go today, probably for Abbott, because Medtronic has been struggling over the last 2-3 years a little bit to find really proper growth. So I like them a little bit more.
Look, Medtronic, both are good companies, have decent histories. Medtronic is more of a medical device company. Abbott I mean, they're involved in diabetes a lot more. I can obviously relate to. I haven't looked at both of them closely enough against to comment. I think they're both good companies. I do own AbbVie, and they obviously have their dividend aristocrat status because they were a spin-off of, I think they spun off maybe 10, 11 years ago, but they have a dividend aristocrat because they spun off from them. But I think both as an overview, both are a good option. Question then, we got a couple of questions actually on National Grid. People know, look, that we like Shell, but the National Grid, they have a monopoly in the UK providing electricity. Revenues are fairly certain, and government plans to cap prices and cover the excess. Not too convinced the government of what they're going to do at the moment, as we discussed, but you're right, they do have a monopoly over in the UK. They've got pretty solid revenue streams. One thing that I'm looking at my screener here that I have, and they have got a gross profit margin of 100% over the last 4 or 5 years. I've never seen that before. I've never ever seen that.
How is that possible?
I'm struggling to see how that is possible. So maybe if you could clarify that for me, Dividend Metals. I don't know if it's true. I'm using Kyfin, which is usually reliable. Anytime I've checked it against annual reports, it is. So I'd be really interested to hear about that. The net income has been stable and growing. Free cash flow, a little bit choppy, but it can be like that with utilities, as we know. Dividend per share is increasing. So looks good fundamentally from my initial screener. I do like that they have a monopoly providing electricity as well. But again, with utilities, there's always that governance, isn't it? So they can intervene at any time that can change that. They have a nice dividend yield, 5.92%. And with the sterling, I don't know. I think it recovered a little bit. But I mean, they could be a nice option. And just because we have Shell doesn't mean we don't like. We get this a lot. We like Shell. It doesn't mean we don't like Total Energies, BP, or any of these companies. I mean, we're open. We just bought Shell, I think, at an attractive price, and maybe have some affinity towards them. But we're still open to.
Yeah, I just want to say I like BP, for instance, from a valuation the most at the moment, and Total Energies is just I like the most that they have the best transition plans towards new energy, and something that I really buy into. It's just like becoming too much of my portfolio, but I've got already ExxonMobil, Chevron, and Shell. But if I would want to own more energy, and that's likely in the future, right, when my portfolio matures, I think Total Energies would be on top for me to add to.
Yeah, and I think that answers actually a question we have later. I was just scrolling through from Le Collector de Dividends, one of our French dividend investors, I would imagine, but obviously asked for our opinion on Total Energies, which I think you gave. Did see something in the news today, posted in our dividend chat, about some part of complicity in war crimes with Russia planes and so on. So I mean, I don't know how true that is. It was posted on Twitter by AFP News Agency, but it's quite interesting when you see something like that pop up. Stories like that can create buying opportunities, I think.
Yeah, I think as well.
Okay, life with dividends. Question especially for you, European DJI. Are you buying DLR at these levels?
Not at these levels. I mean, it's $90 now. I initiated a position of really few shares at $150 at the time. So DLR is Digital Realty Trust for the listeners. It's a real estate investment trust in the States that owns and operates data centers, and it has the big tech as clients. It has been rapidly expanding over the last years. You can imagine cloud is booming. Issue that I have a little bit since I bought some shares in the company, I've been also tracking it for the last, let's say, 1.5 to 2 years. Yeah. They're hardly growing their funds from operations in a decent way. So, and I think I mentioned that before on the podcast, like, who is benefiting here? I think it's big tech. Although $90 is below my fair value price, my fair value is around $100, so it's now 10% margin of safety. If you would have asked me half a year ago, I would have bought it. The issue that I have now with it is that we're in a candy store, and digital realty trust is not for me that high of a quality that it comes first to my attention. Maybe it should be. I don't know. I will have to look further into it. But yeah, I think my answer already showed that it's not that the stock that is first on my radar at the moment. And this is what we know, right? And it's like a scavenger hunt, and like finding a needle in a haystack during good times, and then you put it on your list. But then during these times, there's so much on sale. Yeah.
Makes sense. Centrino has asked us, what is the withholding tax of the Allianz stock?
I believe 26.375% because it's a German stock, but I might be wrong on the digits.
Yep. Another question about National Grid, which we talked about. Katsu has asked us, for cyclical sectors, is there a price point you would sell a holding and look to re-enter at a lower point? It's a good question, because there's times, and we've talked about it, there's times when you think about it, but I mean, I think I've got this wrong so many times even talking about it, that, but in theory in theory it can make sense, particularly with cyclical stocks, because like Rio Tinto, for example, they go up, they go down, they go up, they go down, and it makes sense.
I would rather say that not about selling. I'm more looking at when buying more at the bottom of a cycle, because selling, again, look at the cash flows that are coming into Shell right now, balance sheet clean. So I really hope they are putting a new fundament in place, a new floor in place, for also dividend growth and such. I find it so difficult, Katsu, to answer this one. I'm typically not doing this. I'm rather looking at buying at the bottom of a cycle. But now that we're going to a bottom of a cycle for some other industries, I'm focusing again on high quality. So I think I usually end up buying cyclical stocks in the middle of the cycle when the rest is nice, clear water. Then they give still some attractive dividends. I guess that's reality if I look at my past investment performance.
Cool. Div Collector has asked us, since the dollar is so expensive for us Europeans, he's buying US stocks in euros. This means he still profit from the strong dollar because the dividends are being paid in dollars. But if the euro restores to the old values, he won't have the currency loss. What are your thoughts?
It's too late on a Friday evening.
How do you do that? How do you buy US in euros?
You can just buy the European ticker, right, on the European Stock Exchange. So you have Johnson & Johnson trading in Europe. My assumption always was that those stocks also are currency sensitive. So when the dollar, let's say all else being equal, if the dollar would get stronger, that, for instance, the euro share price would go down. Yeah. But honestly, I've not studied it enough to give a meaningful comment on this.
Yeah, I would imagine. I'm just guessing here, because clearly I didn't know you could do this before, but I'm imagining that the currency is built in here. Otherwise, there's a huge arbitrage.
Yeah, exactly, exactly. And then I will play the arbitrage.
Yeah, you can make money that way. So I don't know if you are actually benefiting as much as you think you are. I mean, I'd have to do the math. It's just off the top of my head, but it seems like too good to be true in my eyes. And as I said, there would be a huge opportunity where if you would just churn these out and make lots of money if you could. But I don't know.
And Div Collector, when you're listening to the show, please let me know, by the way. Tell me from an evidence or fact point of view. I assume you pay for those stocks 15% dividend tax, right? Not, for instance, if you buy them in Germany, 26.375. Just let me know, because sometimes I start doubting again about this, and it would save me some time looking it up.
Yeah, and look, I'd love to be educated on this as well. I'm struggling. Okay, I found Johnson Johnson in France trading at 169 euro. What are they trading at in dollars?
Yeah, that's almost the same.
Almost
165, 166 or something like that.
Yeah, and it's probably in line with the dollar to euro. So okay, cool.
Yeah.
Look, I'd love to know. I'd love to know your reasoning behind that. Maybe if you did some math. I mean, I'm an engineer. I do quite like math sometimes. So if you could send me on some more information, and we'd see what that's like. But I just can't see the benefit on both sides at the minute. Dave S, how are your portfolios doing versus the secondary benchmark of the market index? I appreciate that your primary goal is Paddy, but capital value can't be ignored. It can, and I do. I mean, look, I don't mean to be blunt, but I don't look at capital appreciation in the short term. You focus on companies that. What I'm trying to do is focus on companies that are growing their top line, the bottom line, their cash flow, and their dividends. If companies do that over a sustained period of time, their share price will grow. I think that's proven.
Should grow. Yeah. Yes. And if it doesn't, there will be something else wrong.
Exactly. So I don't look at that. I don't look at that in the short term. I don't compare myself to indexes. I purely focus on cash flow. And the reason for that is I've done that in the past. And then you're getting into what we discussed earlier. Maybe I'm selling a company, try to make extra profit, and I'm doing all sorts of stuff like that. So I prefer Paddy. I don't look at myself compared to the markets.
I compare myself only to my financial plan that I put in place once a year when I write my annual report. I really look like, have I been hitting the numbers that I need to reach financial this crossover point at a certain time? For the rest, you know, there is also no index that compares to my investing style, even a dividend ETF not, because you buy a basket there, and I'm not buying a basket every month. I'm buying individual stocks every month. So, you know, there's just no benchmark for me in this regards.
Yeah, I think sometimes people can get too hung up on beating markets and beating this and beating that, and look, there's times and there's places for everything. I get it, but what do you do if you're not beating the market? Do you make a rash decision? Do you sell? Do you sell at the bottom now? Or what exactly do you do to try and beat that? So it's, for me, I don't have the right mindset for that. I just prefer to compare myself to myself, forget about everything else, and then let it grow over time.
Yeah, and it has not been doing bad for you. I think your let's say your wealth has been growing because of all of this, right? To focus on passive income.
Yeah, it's nearly 11%, and that's just dividends, not inflation adjusted, I must admit. So I'll have to maybe readjust those figures, but 11% from dividends, probably the same from options. So it's actually doing quite okay. If I was to look at total return, I don't know how I'm performing. I really don't. I really don't know how I'm doing against it, but I think I'm doing okay. I mean, my core dividend growth portfolio is actually not down a whole ton. What's killing me is companies that I own part of my option trade. That's what's killing me. But if I was to isolate those and focus purely on dividend companies, I would say I'm beating the market.
Yeah. I have something similar at the moment. I was actually thinking about it, about the 10% of growth stocks that I invest in to nurture my inner needs there. I've got Alibaba in there, Facebook in there.
Yeah.
So next topic. UK Dividend Growth is asking us, can you review Intel at this stage, please? Seems like a bargain now, value play or value trap.
Yeah, look, it's hard to know, but what I will say is that there will be dividend day on the 27th of October. They've confirmed their date for the earnings. We will be in a much better place to answer this question after that. I know we spoke about them, but I would still like to see their earnings. Are they a bargain now? Technically, yes. Are they a value trap now? Technically, yes, they could be. So we've mentioned it. It is a turnaround, but I'm definitely looking forward to their earnings this quarter.
Yes, and when EMF says dividend day, it means that we are going online with some of our investment buddies to actually just talk with each other, and we will be waiting for the Intel earnings to come out and reflect a little bit on this. It's a tradition that we started 2 years ago. We have quite some people now online, so if you would like to join, if you're like a long-time listener or something like that, and just would like to have like-minded people to talk a bit with, and to have the joy of, hearing others talking about dividends, but also, seeing Intel go down 10% again, and we're all laughing, but of course with a toothache because we all own it. Let us know. Reach out to EMF or myself. Ping us. We'll put you on a list and we'll send you an invite on the day that we're meeting. Usually, if we are in European, like mainland, the stock market closes at 10. Usually, we get at 9:30 online, so that at 10:30 or something like that, we are already warmed up. See the report coming in, and we usually stay till 11 or 12, just to hang out with a beer and have a conversation about dividends.
That's Central European time, but yes, I missed the last one. I promise you I'll be there this time. I'm ready for it. I can't wait. So anyone that wants to join, let us know. And look, we look forward to seeing all the usual faces. That's the last question. It's this episode has completely flown by. It was a good topic to talk about. I think we get a lot of questions around dividend. I even got it into questions there about focusing on total returns. There's a lot of talk about dividends. They don't work. I think if you look back over time, dividends have a huge role to play in the market. Dividend growth investing is time proven. Warren Buffett makes a shit ton of money with it, so I don't see any issues with it. But no, it was a nice topic and nice chatting to you about it.
Super. So the only thing that lasts me is to wish you a great weekend, and we'll talk next week again. Earnings seasons are starting.
Look forward to it, and we'll see all our listeners. We'll see you all next week.